Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major equity markets. U.S.-China trade tensions played a big role this past week, plus Ross looks at the U.S. and Canadian dollars. The Corbett reports. James Corbett reports from Japan on China's economic difficulties, Hong Kong, and whether the U.S. had its technology secrets stolen by China. Ted Dixon from inkresearch.ca comments on the U.S. Fed, interest rates, Canada's mid-caps, and REITs. Plus, right after the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. Welcome back to the show, Ross.
Always good, Jim.
Ross, the U.S.-China trade wars, again, radically affecting the markets, especially late in the week. Can you tell us what the latest kerfuffle's all about?
Well, here you are, 10 days ago, they're talking about how well the negotiations are going on. And the end of the week, the U.S. now is looking to put pressure on the Chinese. They're talking about putting some caps on capital flows in and out of China, clamping down on investments there, and also possibly doing something in terms of limiting the listings of Chinese companies on the American stock exchanges. So this is, putting just a wrench into everything as far as the investment decisions are concerned, not just for the investors who trade by day, but, for corporations who got long-term investments to make. This is, stability is what you want to see in terms of policies, and there just isn't anything out there right now. So, what do you end up with? A market that thrashes around, and depending upon the index you're looking at, the last 10 days was a test of the highs of the year, in some cases of the high of January of a year ago. But there's just no momentum in this market right now. So the thing that we're watching is that there was a nice base in August after a good sharp sell-off and a nice buy signal in there. We had a really good run-up into September, but if we start to see this market overlap the August highs and eat into that August consolidation, that would really end up looking like a rolling top as far as markets are concerned. And unless you get one of those big Eiffel Tower moves like we had in Bitcoin 2 years ago, most times the equity markets and the indices create these rolling style of tops where they run out of momentum, the earnings start to come in a little bit shy, and then you have a decent corrections. So if we look at the S&P, which is sitting at 2960 right now, support area around those August highs is at 29.25. If it starts to eat through that, gets down to 2900, clearly it's not just starting to roll over, it's starting to give up enough ground that we could be looking for a pretty decent correction.
Gold and silver, how well have they been holding up with all the different pressures on them?
Well, surprisingly, when you look at it, if you take a look at gold and silver measured in U.S. dollars, they've been holding up pretty darn well. 1485 for gold. It's been down there a few times in the last 2 months. 1750 on silver. They look like distribution patterns. There's a head and shoulders type of top that's sitting here on the gold market, with the last spike being at the early part of this week when it got up over 1530 but couldn't hold that. It ended up closing back just over 1500. But historically, head and shoulder style of tops in gold don't have a lot of follow through on the downside. So if they and this, when you think about how well the metals have done in the last 6 months, with the movement we've also seen in the U.S. dollar, the U.S. dollar has been strong. So you'd expect to have seen the metals have some difficulty here. They've done very, very well. So if the metals start to give up a bit of ground, I think that you could be looking at support in the gold, probably not all that far down, maybe the 1460-ish level. Silver, which is at 17.5, you're probably looking at 17 for the first support, and much better support down around 1650. But that's probably because of the strength that we've seen in the U.S. dollar index. And when you look at the dollar index, there's a few ways that it's put together. The DX, which is the most common one that people look at, is up near the highs of the year. But if you look at the UUP, which is a slightly different makeup, it's not only broken out of the high of the year, but this is the highest level in 11 years. You have to go back to 2008. So dollar's strong. Metals have been holding well for now. One more good clean out on the precious metals might be just enough to take out some of the weak longs and set us up for the next leg on the upside.
Has it been surprising the Canadian dollar has been able to maintain 75 cents U.S. for such a long time?
Oh, yeah. I mean, I always look for divergences on the Canadian dollar for highs and lows when you compare it relative to the oil market or to the commodity indices. And we haven't seen any guidance there to say that this thing is ready to move outside of its trading range. The dollar's been just, other than maybe one spike down in December, it's been stuck in a 2-cent trading range, and it's dead center on that right now. This is, as I say, with commodities having had a bit of price action, you think about the from a geopolitical point of view in terms of what's going on with exports to China, etc. Dollar's holding in reasonably well, and we just sit back and wait to see if we get signs that there might be a movement afoot. But for now, just sitting on the sidelines in terms of any recommendation.
Ross, does Charts and Markets have any articles or analysis reports coming up that we should be looking for?
Well, we've been looking at the utilities index in the United States, and it is getting up to some extreme levels at this point. Put together a report at the end of the week, and that's something that the listeners are interested in. They could drop us an email at rossclark@chartsandmarkets.com.
Ross, thank you so much for chatting with us.
Nice to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. He was speaking to us from Vancouver. Reporting from Japan, James Corbett, next on This Week in Money.
Always consult your investment professional before making any investment decision.
Grand Portage Resources' Herbert Gold Project in southeast Alaska highlights increased gold resource, indicated and inferred, of 860,000 ounces, in excess of 10 grams per ton gold. Expansion drilling is planned on the Herbert Gold property for the summer of 2019. Grand Portage Resources trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is James Corbett, publisher of thecorbettreport.com and editorial writer for the International Forecaster. He's speaking to us from Japan, where he has worked and lived since 2004. Welcome back to This Week in Money, James.
Well, thank you for having me back. It's a pleasure to be here.
James, what's the latest with the Corbett Report?
Well, I have just recently published a new 2-hour documentary. It's called 9/11 Whistleblowers, and it relates to various people who have talked about aspects of the 9/11 story that are not part of the official 9/11 narrative, including even commissioners of the 9/11 Commission report. So that's up for free viewing, as with all my reports on corbettreport.com/911 whistleblowers.
Now, is that about the people who had good intelligence that something bad was about to happen?
There were a number of different aspects there that I could have gone with. Some of them relate to, for example, people like Kevin Ryan, who was working for a subsidiary of Underwriters Laboratory, which underwrote the steel in the Twin Towers, and his personal experience of dealing with the investigation that was ongoing into the collapse of those towers. I talked about Michael Springman, who was working in the Jeddah consulate, where 14 of the 19 alleged hijackers received their visas, and he had an interesting experience working there in the late 1980s, rubber stamping visas for terrorists, as he outlined in his book about his experience there called Visas for Al-Qaeda. I talked about, for example, Kate Jenkins, who was an EPA scientist, worked at the EPA since 1979, blew the whistle on the EPA's attempt to cover up the air quality at Ground Zero in the wake of 9/11, and they attempted to oust her as she fought back, eventually won back her position after several years of legal wrangling. But as of course we now know, she was very much right about the hazardous air quality around Ground Zero, and many hundreds, if not thousands, of people have died and are dying from the effects of that and the attempts by the government to cover that up.
U.S.-China trade talks. What's the latest you've heard?
Well, the latest that I've heard, like I'm sure everyone else by this point, of course, President Trump said earlier this week that a trade deal could happen sooner than you think. And so, of course, we saw the Dow Jones jumping as if on command, 150 points following that bold declaration. Of course, it is worth exactly as much as the paper that it's not printed on, which is to say nothing at all. It is just more hot air bloviating from Washington. So I don't put any stock whatsoever in such pronouncements. And it's humorous to me that the stock market would react to such a thing, but it just goes to show how far detached from reality the stock market is at this point. I don't think that there's been any significant progress, and I'll believe it when I see it, at any rate.
How much of China's economy has been relying on trade with the U.S.?
Well, almost, I would venture to say almost all of it, and not just in the ways we are being told. This is not just about agricultural products or even just about high tech, although obviously there's a lot of tech innovation going on here. But it's all sorts of transfers of technology and economic power to China that has been obviously part of this whole process of building the Chinese dragon over the course of the past, not only 2 decades. This extends back to the Deng Xiaoping era and the so-called capitalist road that took over in China in the late 1970s and immediately started making deals with kingmakers like David Rockefeller on Wall Street and starting the banking infrastructure that became the basis for the transfer of technology and jobs to China, which obviously has been the predominant narrative of the last couple of decades. So this goes very deep, not only into the Chinese economy, but essentially into the American economy now, or at least what's left of it. And this has been a very deliberately planned out agenda, basically, to offshore not only the economic productivity in terms of manufacturing and jobs, but even the innovation and research and development has been a huge part of this. In the 1990s alone, you had Motorola and Nokia and Siemens and IBM and Microsoft and GM and Samsung and Nortel and GE and JVC and Intel and P&G and DuPont and Ericsson and Matsushita and Mitsubishi and Lucent and Bell and AT&T and many others, all have opening up R&D facilities in China, all of which came with specific strings attached, specifically stating that they would have to allow the Chinese government essentially access to some of their technologies that they developed there. And this has been an open and known part of this going on for decades now. In fact, the U.S. government itself has released its own report on the U.S. commercial technology transfers to the People's Republic of China, where they conclude that this is part of a continuing trend that has been developing for years with the active aid of Congress. And we saw in the 1990s, for example, the reporting about the Clintons helping to transfer military technology to China at that time. It came out just a decade or so ago. George Bush's brother, Neil Bush, had intimate ties to a Chinese microchip maker. I mean, there's a lot of deep-seated ties in the American economy and government complex that have basically been facilitating this rise of China. So it's a very deep and profound relationship that goes much beyond the kind of surface-level trade issues that are dangled out in front of the public.
President Trump wants intellectual property theft on the table for any trade deal with China. How can China make restitution for all the intellectual property theft?
Well, that's an interesting question, because it comes with it embedded a lot of assumptions about what this technology theft, so to speak, is really about. And in fact, a better way to frame this is the theft that's going on from Washington to basically transfer this technology over to China, which I hinted at there, and I've talked about before on my podcast, for example, on episode 297 of the Corbett Report podcast. But I was writing about this idea recently when it came specifically to military technology. And I highlighted in an article for The Forecaster called China's Suspiciously American Arsenal, a closer look. I highlighted side-by-side comparisons of a number of technologies that China, military technologies that China is rolling out that are, shall we say, suspiciously similar. A better word for it might be identical to the American versions. For example, the Chinese version of the X-47B looks very much like an X-47B, or the Chinese version of the F-35B Lightning II looks very much like an F-35B too, or unmanned helicopters and other such technologies that China is rolling out miraculously always seems to look exactly like their American counterparts. And in fact, I even highlighted one example of a new Chinese technology that was being highlighted about drones and radar tracking that was being highlighted by an official Chinese government source that even in their demonstration included English readouts on the display, which even Popular Mechanics was compelled to note that it must be a remarkable coincidence that it doesn't seem apparent why they'd be using English displays, unless, of course, this technology originated from the United States or other Western countries. Well, bing, 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 that's exactly where this is coming from. So rather than framing this as intellectual property theft, I think the more important part is who are the thieves and what is being stolen and for what purpose. And I think once you start to put the pieces of the puzzle together, it's quite evident that China is being built up by American technology transfers that are being facilitated and greenlighted by Washington and some of the players there.
We'll have more with James Corbett when This Week in Money returns.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with James Corbett. James, what's the latest on China versus Hong Kong, or is it really a versus or assimilation?
Yes, well, good question. Well, I suppose it depends who you ask. If you ask the op-ed writers of the Wall Street Journal, you're going to find out that Hong Kong may topple communism, according to them, and they think that this might be the beginning of the end of the unraveling of Beijing and the Chinese regime. I don't tend to believe that myself, but you can go and read their report and their mostly American sources that they relied on for compiling that report and come to your own conclusions. I think that this is just another extension of what we've seen developing essentially since the takeover of sorts happened in 97, the transfer at any rate of Hong Kong obviously over to Beijing's sphere of influence. It's a special administrative region, whatever that means precisely. And of course, that's part of what this is all about. What does that mean precisely? And of course, every player has their finger in this pie, including the United States, which has just passed a bill that just made its way through the House. What was the actual official euphemism? The Hong Kong Human Rights and Democracy Act of 2019, basically reaffirming that the U.S. will only work with a democratic and free Hong Kong, that if China attempts to intervene, then all bets are off the table, which is essentially just reaffirming what the U.S. Has officially had on record since the early 1990s. And in fact, I did point in a recent Forecaster article to a 2014 interview that took place on FoxNews.com that was conducted with an old hand of the Bush 1 regime, who was talking about relations with China. And it was pointed out at that time, during the umbrella protests that were going on back then in 2014, it was pointed out, well, China, the Chinese government and Chinese mouthpieces are saying that the U.S. is involved in this. What do you think? And they turned to this old Bush regime hand, and he admits, well, of course, we do spend millions of dollars on democracy groups in the region, and of course they do have a role in this. So the Chinese aren't completely wrong about this, which remains true to this day. If you go and follow the funding to the National Endowment for Democracy, which is just an extension of the CIA, you find that they have their money and their fingerprints all over this, which is not to say that there's not a legitimate protest movement in Hong Kong. There certainly is, but unfortunately that, like so many other events, is being manipulated from all sides, from the Chinese side, from the U.S. side. So what the Hong Kongers really think and feel tends to be the excluded part of this conversation. At the very least, we can say that the protests are continuing, and there seems to be no sign of them completely abating at this point. So there's definitely going to be, this is going to come to a head one way or another, but I don't, unlike the Wall Street Journal op-ed writers, I don't see this as toppling the Beijing government anytime soon.
Are you bullish on Hong Kong going forward?
Well, I suppose that depends on exactly what you mean. Just in terms of markets and what have you, yes, I don't think that this will fundamentally upset the market equilibrium. Although I think in the long run, this will have ramifications, as I think Hong Kong is becoming more under the Chinese umbrella, economically speaking and financially speaking, and less of the kind of less of a Western toehold into China and the Chinese financial and economy, so much as a Chinese toehold into the Western economy, if you understand the difference there. I think Hong Kong has always been that sort of Western access to China and to the yuan, but it's kind of flipping the other way around, and I think China is becoming the more dominant part of that relationship. I think that process will continue, so that fundamentally, in the long run, I think Hong Kong will be in the Chinese economic sphere more so than in the Western banking sphere. But that's a process that will be ongoing, and I don't think it's going to be resolved simply with these protests.
If China was a stock, would it be a short?
Well, it's an interesting analogy to use, which again I think relies on the common sense notion, which it has been demonstrated to be completely wrong, that the stock market actually reflects actual market reality, which we know at this point it's far detached. But if it were reflective of actual reality, would China Inc., so to speak, would it be short or long? I think it depends on the outlook. Short term, I think a lot of negative things are developing for China, but I think long term, I think the goal and the vision has always been longer term. China, not just China 2020, but China 2030 and outwards from there. I think the Chinese regime is perfectly happy to outlast the Trump regime, which will one way or another go, if not in a year from now, then 4 or 5 years from now, it will be gone, and Xi Jinping will still be president for life. And I think that's kind of the long-term outlook and aspect that this has. And in that regard, I still think that China is working closely with a lot of the Western banking institutions and industrialists and financiers, and as it has that kind of deep level of support from the West, I think it is being set up to be the sort of bipolar challenger to the United States, in the sense that the Soviet Union was built up similarly through a process of technology transfer and other things in the mid-20th century to be a rival to the United States that justifies the U.S. Cracking down on its domestic population and also, of course, spending lots and lots of money on the military. I think this is a similar situation, and I think that's why long-term China does have a positive outlook if you want to look at it from some sort of strictly economic sense. But unfortunately, I think that's a negative thing for the world because it does mean Cold War 2.0.
Are any of the statistics that have come out of or coming out of China likely to be accurate? I know we used to joke that every year they would say 6.7% growth, and exactly a year later they would report 6.7% growth.
Yes, exactly right. I mean, it is a joke. Whoever would take China's official statistics seriously needs their head examined. And I have written about that for the Forecaster before. I would suggest people go and look back at that, talking about China fudging their gold numbers and everything else. It's just so ludicrous on its face. I mean, just basic mathematics that do not add up, like the different state and provincial GDPs not adding up to the full national GDP and things like this, which, I mean, clearly show that they're full of nonsense. In fact, we even had Li Keqiang several years ago in a leaked diplomatic cable having admitted that, of course, the GDP numbers are just total nonsense and just cooked books. So in order to find the real GDP of China, you could use things like, and then he was talking about some of the economic indicators that you would actually look at if you wanted something approaching the truth. Again, people can look into my work for more on that. But yeah, I mean, there's just no attachment to physical reality in the numbers that come out of there.
China's been printing money like crazy for years. Could China's economy collapse under all of its debt?
That is certainly a possibility. The question is, who would come to collect on that debt and in what way? That's really the question, because, of course, China has been acting like the United States and other countries do, which is to print money into existence like there's no tomorrow. But in the U.S. example, of course, that has been done through, for example, quantitative easing, where it's used to buy toxic mortgage-backed securities and other toxic assets that just basically get parked in the reserve accounts of various banking institutions and just inflate the Fed's books, but don't do much in terms of the actual economy. China has at least been using its crazy money printing to create actual physical infrastructure. And then the question is, okay, well, who's going to come collect on that debt if it collapses, and in what way, and who's going to physically take that over? I mean, that's where it starts to become a whole different calculus, because then you're not talking economics, you're talking geopolitics, and unfortunately military geopolitics. So could a Chinese economic collapse, a debt collapse happen? It certainly could, but what would that actually look like? And again, unfortunately, I think that would not look good for the world at large, as that's when large-scale wars tend to take place.
We'll have more with James Corbett right after the break.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with James Corbett. James, is China today comparable to Japan in the late 80s when they seemed to be buying anything and everything around the planet?
Right. I think there is an analogy there to be made, although I don't know how strictly we can use that analogy. Certainly the Japan bubble of the 80s was largely as a result of central bank intervention at that time, and basically an early form of QE that did explode spectacularly around 1990. So we know how that left Japan in its wake. But I think at the very least it is an interesting narrative to compare to China, because, of course, in the late 1980s, Japan was going to take over the world, and everyone envisioned the future like a Blade Runner type future where everything is owned by Japan, even in the United States. Now there is some talk like that with regards to China, at any rate. But again, I don't think we should take this talk about China taking over the world any more seriously than we should have taken the talk about Japan taking over the world. And in that sense, I think the analogy might hold. But in terms of the actual economics of what's going on, I think the Chinese economy of 2019 is quite a bit different than Japan of 1989.
Did China's hyper money printing lead to real estate bubbles around the world?
Is it the only factor leading to such things? No. But is it a contributing factor? Certainly. I mean, I think demonstrably so, and probably most obviously in places like in British Columbia and other places where obviously a lot of Chinese money has flooded in and artificially inflated housing bubbles there and elsewhere. So yes, I think, has it been at least partially responsible for that? Yes.
People from mainland China are relatively new to real estate investing. Are they likely to sell their real estate around the world towards the bottom of the real estate bubble, just like what happened during the dot-com bubble burst?
Well, I think it would be a folly to think of these investors as investors in that sense, so much as people who are simply trying to get money out of China and parked somewhere safely halfway across the planet. And I think that's more of the concern here. So I don't expect these people to be acting as regular investors in a regular market. And also the lack of liquidity of such a market makes it more difficult for them to simply just dump stocks like the dot-com investors dumped stocks back in the day. I mean, these are actual physical assets that have been purchased, usually at great pains and difficulty, and probably a lot of it illegally through money that has gone through the capital controls that China has placed on this money in the first place. It's doubtful that they'll be able to liquidate it and move it around or bring it back to China in any usual way that an usual investor would work in a typical market. So I think that's the wrong way of looking at it. I think there's a lot of investors in these markets that might be riding that down to the bottom because they'd be happy to have physical real estate in a foreign land, let alone whether it's inflated or not.
There are rumblings China has financial relationships with a number of politicians around the world. What are you hearing?
Well, absolutely so. I mean, it would be almost inconceivable if certain arrangements and above board and under the table were not being made constantly by someone in a economically dominant position, which China increasingly is. But of course, as I've intimated a number of times in this conversation, that entire dominant position has been fostered, shall we say, by these very types of relationships with politicians that again extend deeply into some of the highest offices of the land, including, of course, not just the Clintons, but the Bushes and many, many others. And, of course, those in economic power as well. So I think there's a lot more to that story than is intimated. Sometimes it's just framed as, oh, this Australian prime minister is bought and paid for by China or something along those lines. But I think more than that cartoon level of reality, there's a much deeper relationship that exists specifically between, I think, Beijing and Washington, that has led to the dominant position that China finds itself in today.
Is China trying to infiltrate Western society? And if they are, why?
This is where we get into a lot of Orientalism, speculating about those strange East Asians and their weird mindset. And this leads inevitably into the type of clash of civilizations narrative that I have seen is being fostered right now, including by high-level government officials. There was some strange statements that were being made recently, even by people like Kyron Skinner, who's the director of policy planning at Pompeo's State Department. And she was saying at that time, a few months ago, at a future security forum in Washington, she was talking about China as an economic competitor, an ideological competitor that, for the first time in history, was not Caucasian, which is an interesting way of framing it, and basically saying that it's a fight with a really different civilization and a different ideology. And this, of course, frames it in some sort of clash of civilizations type of narrative, which we all know how that goes. That, of course, was the way that the whole Islam versus Western civilization clash was framed in the 1990s and helped, I think, give rise to the narrative that became what we now know of as the War on Terror. So be careful what you talk about. It may come true in some form or other. And that's, I think, the way things are heading. I wrote about this recently in the Forecaster Clash of Civilizations 2.0. I think it's not, I think a lot of this is overblown. And certainly, does China want to exert cultural influence around the world the way the U.S. has exerted cultural influence around the world? If they could snap their fingers and make that so, I'm sure they would. But what country wouldn't would be a good question to frame this issue. It's just a question, can China now more effectively do that? And since they are holding a greater and greater economic lever, that does give them some leverage to do that.
Does China have ongoing internal civil unrest we don't hear anything about?
Yes, of course, constantly. And they are constantly trying to suppress anything that looks like unrest, which is, of course, why we are now seeing the rise of this totalitarianism 2.0 or whatever it is exactly, with social credit scores and this type of regime that's being put into place with the cameras and all of it being networked together so that any even hint of disobedience could be cracked down on at a moment's notice. And we're starting to see the really creepy Orwellian ways this is being implemented in order to crack down on, obviously, civil unrest. Why would these types of systems be put in place? Precisely to crack down on civil unrest. And, of course, one of the most worrying things about that from the Western perspective is that a lot of these same ideas are worming their way into Western countries as well. And I think we would be naive not to see some of the parallels of these the creation of the social credit score type of surveillance infrastructure going up in the West, and not seeing what's happening in China as sort of a bellwether of what could happen in the rest of the world.
Are the banks in China making it tougher to get mortgages and loans?
China is attempting to walk the very fine balancing line. They've had a number of cash crunches and a very destabilizing shadow banking industry that's taken off in the last several years as investors have been chasing unrealistic expectations that have been set in the first decade of the 21st century. They're still trying to chase those and going into the shadow banking industry to do it. So China has been trying to tamp the spigot, as it were, but every time they do so, they end up with a cash crunch or other type of crisis that means they have to open the spigot up again. So it's more like walking a type of delicate balancing act and hoping they won't fall off that ledge. And if they don't, I mean, it will be something of a miracle. I think the question more to the point is when and if that will happen. And unfortunately, I think I'm running out of time here. I have to get running to my next interview.
James, always great talking to you. My guest has been James Corbett, publisher of thecorbettreport.com. He was speaking to us from Japan. Coming up, Ted Dixon, next on This Week in Money.
Cypress Development Corp is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. I'm speaking with Ted Dixon, CEO and co-founder of InkResearch.ca. He invented the Inc. Canadian Insider Index, which is used by the Horizons Canadian Insider Index ETF, a 2017 and 2018 Fund Data Fund Grade A Plus award winner. Ted, welcome back to This Week in Money.
Jim, it's a pleasure to be back.
Ted, what's your pick for stocks now that everybody's saying with October just around the corner that we might see a major correction in the equity markets? Should you go for value stocks, big movers? What's caught your attention?
What's really caught my attention the last few weeks has been actually the money markets. Now, before all your listeners kind of doze off and turn the channel, hold on, because what's been happening in the U.S. over the last few weeks is very important. What we've seen taking place, at least, in terms of things to keep your eye on, is the drying up of liquidity on an overnight basis where the big banks and the smaller banks in the system have been scrambling to get enough money to meet their requirements. And it's pushed U.S. interest rates up above what the central bank wants to keep them at. Now, the Fed cut interest rates by a quarter point earlier this month, but right around that time, the Fed funds rate was trading above. Now, the Fed funds rate, that's that overnight rate that the banks can borrow at in order to meet their requirements. It went through the roof, and that's not something you usually see in the United States. That's something you might see in an emerging market, or a smaller market, but in the largest market in the world, it's really something to look at and wonder what's going on. And the Fed got caught by surprise, which is also a bit of a head scratcher. Like, they're supposed to know all this stuff. I mean, that's what they're paid for, and they are the central bank after all. So they didn't see this coming. So they've put in some stopgap measures, apparently. Now, we'll see if they actually end up being stopgap or permanent. Income tax was supposed to be just temporary. Well, we'll see if these overnight lending facilities that the Fed has put in are permanent now, or just temporary. Now, why is that important? Because if they have to keep doing it, it suggests that there is a funding problem emerging in the United States, and this has big implications for all asset classes, for all, for stocks around the world. If this if this becomes more than just a short-term event, we have a big problem on our hands in terms of asset values, because if there is a scramble for cash, that's going to mean people are going to have to sell, and institutions primarily to begin with are going to have to sell some of their holdings to raise cash. So we're not there yet, but we are seeing some potential warning signs that we could head in that direction. Now, Jim, there are two views in the market about this, okay? There's the view, and this is the view that the Fed would like everybody to have, is that this is a nothing burger. Okay, there's nothing to see here, move along. But there's another view saying, well, wait a minute, this could be the big enchilada. You know, and by that I mean it's something too hot for the market to handle. Now, we will probably find out who's right after October 1st, because the nothing burger crowd basically are saying, look, this is just quarter end stuff. It's really, it's been a bit of a problem, Jim, but you know what? It's all going to go away. It's all going to go away in a couple of days. So we will see. So we'll see if it does move away or if it is the big enchilada. And if it is the big enchilada, it begs the question, you know, who can stomach the big enchilada the best in markets going forward?
And who can stomach them the most right now?
Well, this remains to be seen, but we have to see who's best positioned for that at this point. And what we've been thinking about, and you know, and what we've been listening to, you know, is basically, look, we're at this potential fork in the road here, and we talk about this in some of our material, and we set the stage for it in our Insights newsletter, which people can go to CanadianInsider.com and read it for free. Basically, you know, Canadian mid-caps have had a good run here, and we talk about that. But is it time to sort of get out the victory flag? Well, not just yet, because we have this potential liquidity problem coming from the United States. However, if this liquidity problem continues, some Canadian stocks could be positioned to weather it better than other high flyers that we've seen in the U.S. Now, look, I'm not suggesting for a second that every Canadian stock, you know, and the broad Canadian stock market is going to do well if there's a liquidity problem in the United States. However, I think we've got two types of markets out there right now. We've got markets that have been basically priced for doom. So that would be sort of Canadian small cap value stocks, you know, particularly sort of in the automotive area, in the oil patch, and there's been a couple of others, for example, and sort of the smaller, for example, REITs. There's a REIT we wrote about to our subscribers this week, and it's been out there. It's not that small, but it's not that small by Canadian standards, but it's a small cap. It's mid cap, $400 million market cap. It's called Plaza REIT, and this REIT it peaked a number of years ago. It's been on it peaked. I believe it was back in 2016, if I'm not mistaken. And it's kind of been struggling here, and one has to wonder why. Well, it's basically due to sentiment, because this REIT has continued to boost its distribution. It's, you know, it's doing okay, but it's just not in sort of one of those glamorous type of businesses that people have been flocking to and expecting, you know, great growth from. And you know, let's talk about Amazon, okay? So Amazon's had a great run up until recently, and believe it or not, over the last year, this Plaza REIT, which is, you know, a small little company, may not be appropriate for all your listeners. You know, of course, check with your financial advisor to see if it might be appropriate if you're thinking about it. You know, it's up over the past year a little bit, you know, 1 or 2% depending on the day, but Amazon is down, you know, 1 or 2% or maybe even more depending on the day. So we've got this sort of stealth divergence with a small cap value company in Canada that, by the way, was supposed to be destroyed by Amazon because Amazon was going to destroy all the retail REITs in the world, right? Because everyone was going to just do all their shopping online and nobody was going to ever go to a shopping mall again. Well, what this REIT has, betting on is, a certain type of shopping mall, basically outdoor shopping malls. I'm not a shopping mall expert, so I don't pretend to understand why that would work, but it probably has something to do with operating costs. That would be my best guess. But look, this REIT also has a 6.6% dividend yield. And what's the last time I checked the Amazon dividend yield, it was 0. So actually this little REIT has significantly outperformed Amazon over the past year, and its volatility has been pretty steady. It's come off of it went through its bout of pessimism, Canadian pessimism, that everything in Canada was awful, that, we're never going to export another drop of oil, and the Canadian consumers choked with debt. All that's been priced in, or at least a lot of it's been priced in, and maybe it's not all of it's been priced in. If we have a major financial swoon here, it'll get priced in even more. But on the other hand, you've got these growth stocks in the United States, the big ones that are priced in for, sort of perpetual growth, big market power, and there was a lot of rationale behind that, and it's still true that Amazon has a huge amount of market power along with the other FANG stocks. However, it's an election year, and, some of these stocks may now be vulnerable to political tinkering from the U.S., in terms of antitrust promises and investigations. So we don't know what's going to happen there. So there's going to may actually be a risk premium that's reassessed. What I mean by risk premium is that investors may actually want to have a lower stock price, to hold some of these large technology giants, large growth stocks that have been in the fact, priced for growth forever, and, haven't really priced in the implications that they could be hit by a recession. Whereas you have a lot of small cap stocks. I've mentioned one here, but there are many others, that we try and write about for our subscribers, and there's also small cap value stocks in the United States that are out there that, have been priced for doom. And if you do get sort of a downturn scenario, traditionally, stocks that are already priced for doom often, outperform those that have not been priced for doom. So if we get a liquidity crunch and a liquidity squeeze, particularly if it's accompanied by concerns over the economy, there could be a surprise in store for investors, and that surprise could be that the doom stocks that have already been priced in this type of scenario could outperform some of the glitzier growth names. So will we get to that scenario? We'll see. But at this point, it's a scenario I think that people have to keep in the back of their minds, and that we may be seeing a bit of a sea change in the markets from these sort of growth, these glitzy growth stocks with super high multiples to, looking for gems in the rough that are stocks that have, low valuations that have been written off because they're vulnerable to recession. So, that's a potential change that we could be seeing in the market. You certainly, we are seeing that in terms of insider activity, what they're favoring and what they're not favoring. And I can tell you that, we've seen a lot of insider selling in glitzy growth stocks, and we're seeing a lot of buying in small cap value stocks. So that's the foundation, for how we're looking at markets going forward.
We'll have more with Ted Dixon when This Week in Money returns.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Ted Dixon. Ted, is gold still going to be a hot commodity in the near future?
Well, I like to think of gold as an insurance commodity that will probably be in demand, and I can tell you this probably a scenario that could unfold quite quickly over the next 6 months that could be very beneficial to gold. Okay, basically, if the global economy starts to sputter, and if these funding issues continue in the United States, there will be no choice but for the Federal Reserve to try and steepen the yield curve. And what I mean by that is to get So those longer-term bond yields up versus the shorter-term overnight rates down. And there's a couple of reasons for that, but it primarily relates to the funding of the mammoth U.S. government deficits that are, now running around $1 trillion a year. Okay? So if you don't have a steep yield curve, it makes it hard for a lot of players to kind of help Uncle Sam fund their deficits, okay? And without getting into a lot of the details in terms of how that happens, basically, if you want to sell a 10-year bond, you should be offering investors a little bit more of a yield on a 10-year bond than you're offering on an overnight rate. So with the Fed offering an interest rate on excess reserves, there's an incentive that, an interest rate that's higher than or around the same level as 10-year. So if that interest rate on the overnight money is more attractive than the 10-year, you're just going to have more and more players gravitating to that overnight putting money on with the Fed, which doesn't help Uncle Sam directly. And, it's a real problem eventually if you're trying to sell finance debt of that proportion. So the Fed, cannot let this linger for too much longer. And they have two ways that they can engineer this, Jim. They can get those long bond yields up, which means, having more inflation expectations take hold, but they've been failing at that now for 10 years. So that's their track record. And I haven't heard anything from the Fed that gives me pause to believe that that they've seen the light and are going to do what it takes to get those rates up. Their only other choice is to dramatically cut interest rates on the short end. And you know what? We hear them talking, maybe we're only going to do one more cut. We're not going to do any more cuts, right? Come on. This is the same Fed that said they were going to raise interest rates 3 times this year, okay? So you cannot actually believe anything that these people say, because they really have demonstrated that they're as capable of making mistakes in the market as I am, or anyone else for that matter. So you really have to kind of look at what's happening, the facts that are evolving, and we have basically a flat inverted yield curve, and that is just not sustainable for funding a U.S. federal deficit of trillions of dollars going too far into the future here. So they've been able to get away with it this far, but the likely scenario, Jim, is that they're going to have to really cut short-term rates, and that is typically positive for gold, but for all commodities. So we could be in a scenario where commodities surprise on the upside, and even in talk of gloom. So we're going to, we could hear a lot of talk about, the global economy not doing very well. Why would commodities rise? Well, it would be a monetary phenomenon, because the Fed, isn't going to be able to kind of do the same tricks that they did 10 years ago. They're going to have to try something different, and part of that involves politics, and it's an election year in the U.S., so the Fed is going to have to be very careful about doing the old QE that will just basically hand Elizabeth Warren an issue to say, there you go again, the Fed and Donald Trump are bailing out Wall Street, which of course would drive Mr. Trump crazy, because he wouldn't want to be thrown in with the Fed, who he's shown complete contempt for lately. But that would be handing the Democrats an issue to run with if they have to, if they do QE, which would be quantitative easing, which Democrats could easily portray as bailing out the banks. So the point being is the Fed is going to have to do something different, and that will be first, I think, driving down interest rates before being seen as bailing out Wall Street with quantitative easing again.
Ted, if you had to choose when it comes to gold, would it be gold bullion, certificates, gold miners, junior gold miners? What do you think would be the most productive? Or do you spread it around?
Well, we don't look at those two asset classes distinctly. I mean, our focus is primarily equities, and we try and put overall market trends in as part of the context of how we look at equities. So, in terms of gold miners, we're still in terms of our signals, generally upbeat about it. I think you have to be very careful about the management, especially on the junior side. There's good apples and bad apples. That really takes a lot of digging, and that's where insider data can come in. You can see how much skin in the game these players have, and you can take a look and see whether they're going to feel any pain, or if the gain is all being taken out through salaries and consulting fees. Those are very important items to look at if you're going into gold miners, and to looking at the track record of the individuals involved. So I think you have to look at it a case-by-case basis on the gold mining stocks, and just don't jump in there just because Eric Sprott is buying a particular name, because Eric Sprott has a lot of money and he can spread it around, and that's what he does. He's very successful. But if you go on inkresearch.com, you can take a look at Eric Sprott's profile, and he's got many, many companies that he's been investing in. So, some of them are going to do very, very well, but not all of them are going to do very well, because that's just the nature of the business. So, my point being is that don't just jump in there because you see one or two names, or you get a stock promotion about, so-and-so, buying this stock. You have to kind of do your homework, and that's where our signals come in. We're objective. We look at the data. We don't take sponsorships to cover stocks. We look at the data. We're a subscription-based service, so that's how we look at things. We're trying to find the trends based on the data that are going to help our subscribers, because if we don't help our subscribers, we don't stay in business. All right, so we're not out to help individual gold companies. We're out to help individual gold stock investors, and from that perspective, there are decent opportunities out there, and there's a lot of things to get excited about, but there's also some names you probably don't want to have a lot of exposure to as well.
Are you hearing anything during the election campaign that would be good news for business, especially small business, which is the biggest job driver in Canada?
Not in terms of the small business front, not yet, but there is some interesting news for individuals on the cell phone side. That the Liberals have promised to cut cell phone fees by 25%. Now, before everyone says, "Oh, well, that's never going to happen," I think there's two scenarios here, where it probably will come close to happening, and one where it does not happen. And that is, if there is a minority parliament. Now that Justin Trudeau has stuck his neck out and said he's going to reduce cell phone fees, well, he will have to actually deliver on that in a minority government if he's the prime minister in a minority government, because, first of all, people are going to remind him of that promise, and secondly, I don't think you'll have any disagreement with other politicians on that, because just about every voter has a cell phone. Not every voter, of course, but a lot of voters have cell phones, and Justin Trudeau is talking about cutting bills like up to $1,000 a year. Now, I think that's way, way beyond reach, but it would make a difference to people if the cell phone bills came down, and I think every political party knows that. So what does that mean? Well, that means it could be good news for cell phone users, but probably not so good news for stocks like BCE, which we also wrote about to clients recently this week, in terms of what the outcomes could be for them if we get this kind of piling on cell phone bills. So I'd keep an eye open for that. I'd be careful about overweighting telecom stocks in Canada at this point until we see where we stand after the federal election, because if we're in a minority government, Jim, look, the politicians are not going to be focusing on creating shareholder value for BCE and Rogers and TELUS shareholders. They're going to be focusing on getting votes, and if that means forcing down somehow cell phone rates, then I think that will be a priority. Now, if we get a majority government, then it's amazing how these promises can kind of go on the back burner, and the lobbyists are able to sort of say, well, you hear all the problems, you don't really want to do that, and oh yeah, right, we don't want to do that, you're right, and because you don't have to. If a government has 4 years in power, they won't feel the urgency to kind of get round those votes up. So keep your eye on those telecom stocks, particularly depending if there's a majority or minority government. It can make a big difference.
Okay, so nothing really big to help out business. Is there anything you've heard that's scary for business?
Well, not yet, but elections are usually times to make promises and not times to make threats. However, I would be concerned a little bit about the Liberal Party approach to small business, given that they've suggested that they're going to cut at the lower end of the tax system, which is great. This is all very good. That there's a focus to reduce taxes on low-income Canadians, and that's a step in the right direction. So it's quite ironic, actually, that Justin Trudeau is actually taking a page out of the Ontario Conservative playbook, but that's the way it is. That's a positive sign that they're going to cut taxes for low-income Canadians, but the issue is, okay, where are they going to make that money up? And I'm a little concerned that from the Liberal Party's track record recently with Morneau and Trudeau, that they're going to make it up by going after small business again, which of course they're not going to talk about during the election. But hopefully, we'll get some accountability from them ahead of that, and that they're not going to be raising, closing loopholes, as they would call it, on small business, but which is just a political spin for raising taxes. So I'd be concerned about the Liberal Party position on that. And in terms of the Conservatives, well, I really haven't understood much about what they're planning to do. I don't think they've articulated it very well. Still maybe they're holding their fire to be closer to election day. But from that perspective, we're still waiting to hear what Andrew Scheer is going to promise and what his priorities are. So we'll have to see, where that is. But look, politics is always a tough one to kind of get your head around in terms of investment implications. For Canada right now, though, I think at this point in the campaign, we're looking at cell phones, in terms of the impact on cell phone stocks, and I think we're looking at, okay, so we know where the Liberal Party stands on that. Where do they stand on small business taxes? Because they haven't promised not to raise those, as far as I know. And where do the Conservatives stand on tax reform? I doubt, unfortunately, I just don't. I don't think we're going to get a tax reform agenda from the Conservatives. I hope I'm wrong. We still have, as I said, almost not quite a month, about 3 weeks to the election. So there's hope that we'll get some tax reform focus from the Conservatives. Certainly, Maxime Bernier has an agenda. He's not, that would be very reform oriented. Unfortunately, he's being overshadowed by the immigration discussion around his platform, and that the economic part of his platform is not getting the attention I think it deserves. But hopefully, he'll be able to raise some of those issues now that he's been allowed into the debate, which was just an outrage that he was initially excluded. But anyway, that's another story. So maybe he will get a chance to promote that, but I suspect that given the time allotment, it'll all be about immigration, and we won't get much discussion on the economic side. But I hope I'm wrong. Hopefully he'll be able to push forward a reformist discussion in the election. That would be great, because we haven't heard it from any of the political parties aside from him.
Before we go, Ted, can you tell us a little bit about inkresearch.ca for people who may not have heard about what the company's all about?
Right. So we look at what insiders are doing primarily as our starting point for investment ideas. We are 100% subscription focused. We do get a little bit of ads to help with some of our server costs on Canadian Insider through third parties, but we have no control over what those ads are. So we're independent, and we use insider buying and selling. That's legally reported of officers, directors, CEOs. They have to report to security regulators what they're doing with their shares. We track that, so we want to see who's got skin in the game, and we use that information. We put it in context of valuations and technicals, and we use that to identify stock opportunities. And there's a couple of ways you can take advantage of our service. You can start at CanadianInsider.com, which has a lot of free stuff, and we have videos on there as well now. Or you can subscribe to our premium service. It's got in-depth screening and basically the full meal deal at inkresearch.com. It costs a bit more, but you get a lot more in terms of customized ability to to do stock digging, and so it's for sophisticated investors, investment advisors. That's a great place. But for retail investors who just want to have another take on things, and independent, no promotion, just the data, along with our take on things, Canadian Insider is a great spot as well.
Ted, thank you so much for being on This Week in Money.
Well, thanks for having me.
My guest has been Ted Dixon, CEO and co-founder of inkresearch.ca, his website, CanadianInsider.com. He was speaking to us from Vancouver. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, James Corbett, and Ted Dixon. And thank you for listening. If you have any questions for our guests or the show, you can send them to info@howstreet.com. Now stand by for a company showcase update from American Manganese CEO and President Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Thank you, Jim.
Larry, a news release came out from the company yesterday. What was in it?
Oh, we were talking about a coverage we got out of Washington State, a group of universities, and the state itself actually sent somebody up to examine our process, and they came out with a report, so we put out a news release that our technology was featured by the Joint Center for Deployment and Research in Earth Abundant Materials out of Washington State. And that was a big feather in our cap to be featured, a Canadian company, by the state of Washington. So we put that release out. It's starting to catch a little bit of traction today. And we put it out yesterday. First time we put it out during the day, and that's the last time I'll put it out during the day. It seems like people don't bother reading them till the evening or the first thing in the morning. So we want to get ours out first thing in the morning. So that's the story on that. We spent quite a bit of time down there, actually. They brought up a professional camera crew and did a video. And we're going to attach a press release with the where you can go to the JCDREAM video and then catch up on the latest and what other people think about us, and the fact that they mentioned the Department of Energy in there. So that's a real great thing. Now, one of the things that I've been kind of plagued with is this Volkswagen announcement on going ahead with the Gigafactory. In there, they mention the fact that they're going to also be doing recycling. Well, everybody's going to do recycling, and but you know that's easier said than done. So they say their recycling will not be based on so-called thermal recycling, and based on decomposition under inert gas, and we think that that's one way of containing the power in a battery and preventing explosions while you're shredding it. So they're looking at building an environmentally friendly battery. They talk about recycling. They don't go into it. They do mention something interesting. And the recycling recovery rate is supposed to be over 90%, whereby only 50% recycling by weight is currently required by law. Boy, does that law have to be changed. I mean, you can strip half the battery down and you're down to 50% by weight, but you can take all of that battery when you strip it down and recycle it. It's the cathode materials and the anode materials that you have to have a process, a technical process to get those out. And that's something that we do have. But it's interesting that everybody's starting to think about that, because sooner or later somebody's going to wake up to the fact that these are not off-the-shelf processes, that, the first in, and we think we're first in and got the best process out there. You can't get much better than close to 100% recovery of all the cathode materials. So I wish everybody all the best of luck when they're working with solvents and peroxides and everything else to try to get the metallurgically get the cathode materials out of the batteries, because there's inherent problems with that type of hydrometallurgy, and we know that we have a benign method of doing it. We know that the MOU we have with our potential partners in the Netherlands have a cradle-to-grave solution for actually shredding the batteries. No explosions. All of the power from the existing batteries is stored and used in their shredding process. So, I can't think of a better solution than these combined methodologies to actually work on the batteries. And don't forget, as you'll read in the press release, we're working with the DOE and to actually get a process that will help us, have our standalone shredding recycling technology. Now, there's another piece of news that I've just gone through, and that is that the government is looking at, the U.S. government is looking at a agreement with a group of countries around the world, and 9 so far, that have joined a strategic minerals initiative. And the only country that never showed up to sign that was, it was Canada. And but there's the other countries in that are Australia, Botswana, Peru, Argentina, Brazil, Democratic Republic of the Congo, Namibia, and Philippines and Zambia. So, they're trying to do something about getting these strategic materials corralled, so to speak, so that they're not dependent on so much on China. And that's a good start, that maybe they should take a real good look at recycling. There are companies out there that are trying to recycle the magnets and rare earths. So, and we have a solution for the recycling of lithium-ion batteries, and there's definitely some critical metals and rare metals in that process. So, maybe someday, very soon, people will wake up and realize that, this company has a solution here, and rather than just looking and kicking the tires, maybe we should get involved in it, and that's what we're waiting for. Now, other than that, it's been a fairly decent week. The markets have been mostly sideways, up and down by a little amount, and except for the venture exchange, which seems to be cratering no matter where the price of gold goes. And I've had lots of discussion on that before, so I'm not going to go into it. As all I'll say is that that looks like another repeat of 2011 when the predators knocked the market on its ass. So we're happy to be in the space that we're in. We've got something the world needs, and we're just sitting there chomping at the bit to get it going. We expect that we will start very quickly on working on the battery materials we received from the battery manufacturers and the DOE, and to get the results back to them. So we have no doubt in our minds that we'll return good results.
Larry, for people new to American Manganese, what is your company all about?
American Manganese is a critical metals company that is actually a mining company, but got involved in a manganese project in the U.S. that was very low grade. And we entered into a technology agreement with Cometco to try to commercialize the actual mining of 2 to 3% manganese, and we were very successful at that. We came out with a pre-feasibility study that showed we were in the same area as the Chinese on their higher grades on producing electrolytic metal, manganese metal, and electrolytic manganese dioxide for batteries. So the Cometco recognized that the opportunity was there to recycle because of the chemistries, recycle the cathode materials in batteries, and we've gone through a proof of concept. Now we've gone through a pilot plant test, and we've got 2 patents that have been granted, and we're going to be patenting a 3rd number because you always want to have the best edge you've got when you're competing out in the world market with your process, and so we're getting even the costs down, which were quite low to start with on our reagents, and we expect that patent to be applied for very quickly. American Manganese is a public company. It trades on the Toronto Venture Exchange under the symbol AMY. It trades in the U.S. under the symbol AMYZF, and on the Frankfurt Exchange trades under the symbol 2AM. You can get all the information to do your due diligence at our website, AmericanManganeseInc.com, or you can phone me at 778-574-4444.
Larry, is there an email address people can go to and also a website?
Yes, the email address is lreaugh, L-R-E-A-U-G-H, at amymn.com. And our website, of course, is AmericanManganeseInc.com.
Larry, thanks a lot for the update.
You're welcome.
My guest has been Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on September 27th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.